Hey traders, this is Blake Morrow with Trader Summit, and with me is, well, it's Friday. I have Mr. Jim Welsh of Macro Tides. Good to see you, Jim.
Who needs a calendar when I see Blake's face?
That's right. I know it is Friday. Hey, listen,
It's Friday.
I want to say, this is 13 in a row. You called it. You last week we talked, and you said I'm not going to. We don't expect to see weakness in the jobs market at least for a couple more months. We had another beat. The roulette wheel struck green once again, or is it black or red? I'm not too sure. Anyway, we beat the jobs report, and the markets responded positively, even though the market still believes that the Fed's going to eventually cut rates. So where do we stand today? Give me just a brief executive summary of where you see the markets right now.
Well, what I'll say is, first of all, Wall Street's view is that we're not going to have a recession. Earnings are going to go up, and the Fed's going to cut rates in the second half of this year at least twice. So today's jobs number within that context is a perfect number. They revised the last 2 months down, I think, about 149,000 jobs. So, yeah, this was a little stronger than expected, but gee, they softened the last two numbers. It's like the perfect number. If you're looking for the economy not to go into recession, the wages ticked up. But, again, this Wall Street has this view that the Fed is going to cut rates, even though the unemployment rate's at a 50-year low. Inflation is more than double its target. It's outrageous. To me, it's outrageous that they think that, but that's where their heads are at. And so that, to me, is why the market responded favorably. And I still think that there's a chance, as we'll talk more specifically about the S&P, that the S&P can get above 41.95. If you think the economy is not going into recessions, earnings are going to keep going up, and the Fed's going to be cutting rates, that's like Goldilocks.
Yeah.
So there's been no selling pressure. We've talked about that, I think, probably for the last 2-3 weeks. So I just had this sense, Blake, that since the economy was going to continue to hang in there for a while, that's the bedrock for Wall Street. The trouble comes when the economy really starts to show more definitive signs of slowing. I've been, I think, pretty consistent saying mid-year and beyond is where I think that risk starts to really go up. So, can the market hold up? Given the narrative that they're running with, it doesn't get much more bullish than that narrative.
So let me ask you this. I mean, I don't think you're bringing this up in any of the charts that we're discussing. Obviously there's still some pressure on the regional banks. I mean, is this eventually going to spill over to where it really weighs on sentiment and risk?
Yes. Yeah. I mean, the May macro tides, and if someone sends me an email, jimwelshmacro@gmail, I'll send you the May macro tides, because I went into a deep dive, the 6 dominoes of recessions. And the first one is the Fed, changing monetary policy, then lending standards and rates and so forth.
Don't give them all away. Don't give them.
I'm not. That's
okay.
why I stopped after 2. But the main thrust, Blake, is that when banks raise lending standards, it's not an on-off switch. So we increase our lending standards today, but if I'm a company and my loan doesn't come due for 3 months or 6 months, I don't feel the bite of that increase in lending standards until my loan comes due. So, as I've talked a lot in the last 3-4 months, lending standards started to go up in the third quarter. By the fourth quarter, 43% of the big banks increased lending standards. Anytime it's been over 20%, we've had a recession. The small banks are going to even ramp it up higher. And Powell alluded to this in his opening remarks. I think he's seen the data. The Senior Loan Office opinion survey comes out on Monday. I think he's seen the data. And he he intimated that, lending standards went up more. So they know that's going to be a tightening. My point, though, is that it's one of these things. I use the analogy carbon monoxide. You can't smell it, can't see it. But if it hangs around long enough, you're dead.
Yeah.
And slowly but surely, lending standards begin to bite. So to me, the combination of the inverted yield curve, leading economic indicators declining, and then the last straw being the big increase in lending standards, slowly but surely choking off liquidity for the economy. That to me is what is the second half of this year is going to be all about. So to answer your question, next year, I think you'll see a lot more commercial building defaults. Banks are going to cut back on lending. Banks, the small banks under 250 billion in assets, represent 67% of all the bank lending to commercial properties in this country. So there's a big, in my opinion, there's, in that arena, there's the potential for a credit crunch.
So Jim, a couple of things that what he did say this week at the FOMC, and I know you don't have any slides on this, so we can talk a little bit about your thoughts with the Fed. He did say, and it's interesting because you've been talking about it for literally for months. He actually mentioned financial conditions, and he said explicitly that they are watching financial conditions, and that to me means that we don't want to see stocks continue to rally. We don't want to see, we don't want to see, inflation expectations, change much. So what was your takeaway from the Fed? And then we'll get into your charts that you brought. What's your takeaway from the Fed this week?
Well, that was one of the reasons why I thought he would straddle the idea that they're going to hit a pause. On one hand, he'd say, "Hey, we've raised interest rates a lot." He did. He said, "We've gone 5 percentage points." Recognize that lending standards are going up. That's going to be a negative. But at the same time, the labor market is still extremely tight. That's his phraseology. And inflation is way above. He, talked about the different measures. And that is exactly what I thought he was going to say. To your point, not tipping the hand that, oh yeah, we're going to hit the pause button now, because the stock market would have responded pretty aggressively.
Sure.
And it's funny, I heard people say, well, it was a hawkish pause. Well, only if you were expecting the Fed to explicitly say, we're pausing, So in the April 17th Macro Tides, the weekly technical review is titled "One More and Done." So that's my view. They've communicated extraordinarily clearly over the last 12 months. This is what we're going to do. They've done it. So December meeting was the restrictive rate was 5.1. The March meeting, 5.1. That's why I thought one of the reasons why they would go with a 1/4 point increase at this meeting. Now they're where they thought modestly restrictive is. But the point that Wall Street continues to, if you will, disagree is the Fed has said, we're going to keep it at 5.1 for all of this year. Wall Street's looking for rate cuts, I think, as soon as August now.
Jim, I want to argue their point a little bit that probably most economists on the street are not of the experience that, let's say, you are, or even myself. But I come in at a time when the Fed really, the change from the Greenspan Fed to the Bernanke Fed. I mean, there's been a change in guard, and so there's a lot of economists out there that really don't see the forest past the trees, really, to a certain extent. So I think most of them are Pavlovian response of Fed is going to act because that's what they always do. But maybe this time is going to be different. We'll find out, right?
Yeah. Well, you and I have talked about this for a long, long time, because this is a point I've been making since last year, that for someone in the business 20, 25 years, all they've known is, gee, whenever there's a sign of trouble, the Fed cuts rates. Late 2018 being the economy wasn't falling into a recession, but the S&P had just dropped 20%. Oh, we're gonna cut back. We're not going to raise rates anymore. So my point is, Wall Street has been conditioned to believe that as soon as there's trouble, the Fed's going to cut. And the point I've made is they've been able to do that in terms of the FOMC, because if you look at the core CPI and the PCE, for 20 years, they were hanging around 2%. So much so that the Fed said, we really want to try to get inflation up a little bit here, right? So I just think that most people don't understand that when you have a 40-year high in inflation, you can't use the same monetary policy framework that the Fed has used the last 20 years. You're in a different ballgame. Wall Street still doesn't, I think, understand that framework yet. And that's why, we've talked about this so many times,
I know
the Fed wants to avoid the 1970 mistakes of hiking rates. Oh my God, we got a recession. This time it's like, we're going to try to get it up to where it's a little bit of a bite and then hold it there. bring economic activity down gradually. Maybe we can do a soft landing or a very, very soft recession, and that will bring inflation down. That's their playbook. Whether they're going to be right about it, we'll see. I personally think a recession is coming by the end of this year.
Well, Jim, you've been spot on, and thank you for and by the way, before we get into what Jim has brought here, make sure you give him a big thumbs up, subscribe to the channel down below, jump in the comments, especially if you have comments for Jim. He has been really, really spot on guiding you all through this each and every week. So make sure you jump in there and make sure you share the love. Let's get into some of the charts that you talked about that you brought here, because one of them specifically is what the expectations of the market are here.
So Wall Street thinks.
Let's talk about it.
Yeah, this is after the Fed. This is after everything that Powell said, where he was asked specifically, what about a pause in rates or cutting rates? And he said, hey, the unemployment is way low. Labor market's still really tight. Inflation's too high. So within that framework, cutting rates does not make sense. And yet, here's Wall Street, the Fed funds futures are talking about at least 2 rate cuts by the end of December. In other words, the funds rate will be down to about 4.35 from 5.1. So despite the projections at the December-March meeting, nonstop messaging and forward guidance from the Fed, Wall Street just doesn't believe it. And the irony here is that, okay, you can justify rate cuts if you think a recession is coming. But if you think a recession is coming, why do you project earnings to be up 15% from the first quarter to the end of this year? There's a disconnect there, Blake. And I just think that disconnect will get resolved when we see more definitive signs that, yes, indeed, the economy is slowing materially. Oh, my goodness, we actually might go into recession. And I think that happens in the second half of this year.
All right. The next chart you brought over is the, let's see, lending standards.
Real Fed funds rate.
Yeah. Okay. Yeah. There we go.
Yeah. So basically, you can see how unbelievably accommodative monetary policy was. So what chart is showing is you take the funds rate and then you compare it to the CPI. So if the CPI is at 8 or 9% and the funds rate is near zero, you get that spike down what we saw. Now with the funds rate at 5, the CPI is at 5, or funds rate's at 5.1, the median. So you're modestly positive. My point is
this would mean we are now restrictive.
Yes, you can look at it that way. All right. And so my point though is I think the Fed is at this point, they're done with rates. Whether this is the end of the cycle, I don't know, but I don't think they're raising rates in the next handful of meetings. The point being, though, is the CPI is going to drop from 5% last month. And when we get the June reading in mid-July, it's going to be under 3.5. So if you compare this to the CPI, hey, you're going to be at a real rate of 1.5% or higher. And the same way with the other inflation metrics. So even though the Fed's pausing and not doing anything, because inflation is going to come down, the real cost of money is going to increase. The other thing is, and I wrote about this in 2007, how as banks increase lending standards, replay right now is, the Fed holds it at 5.1, but banks are going to continue to increase lending standards. And when the economy slows, banks are going to increase lending standards even more. So my point is the Fed may pause, but the actual impact of what's happened is going to continue to tighten policy on the economy.
So we could literally in this chart, we could see it drift higher even if they keep rates unchanged.
Yes, that is what's going to happen over the next 3 to 4 months.
Got it. Okay.
Absolutely. Yeah.
That's interesting. Okay, well let's talk about the impact to equities, because you've been touting the idea that the S&P is gonna or could possibly break out to the upside. I do want to point out really quick, just so everybody knows this, because it was a number that was on my radar all those last week, 2 weeks. This is a 38% Fibonacci retracement at 40.44. So this low to this high. So it really has held some pretty key support from a technical standpoint that I view. So what do you got here?
Well, what I'll add is that from that high at 41.87, you can see a down, up, down. Those two legs, the down legs, are almost perfectly identical in length. All right. So classic ABC. It took out, the low from last week by a point, and no follow through. You can see a technical indicator that I developed, MACD on the RSI, got oversold at the lows. So again, my view has been that the Fed was going to be one and done. Wall Street will seize, even though the Fed wasn't going to communicate clearly that, hey, we're hitting the pause button. That's what's going to happen. So Wall Street has this view that, hey, the economy is going to keep growing, earnings are going to go up, and the Fed's actually going to cut rates. I just think that gets you a rally. And if the S&P gets above 41.95, which was the high in early February, the technicians are going to say, hey, look, we've got a breakout. Time to get bullish. Fundamentalists are going to say, with the S&P behaving like this, it's telling me that there's no recession coming. So that's the hook I think that the market needs to actually make a top prior to a big decline. Because I believe the odds are we're going to see a significant slowing. Wall Street's going to be forced to cut earnings expectations. And I think as we get into the second half of this year, a decline towards the lows of October, near 3,500, is likely in all that scenario. And if we actually go into a recession with the risk of a hard landing next year, 3,200 becomes a possibility. So for me, it's like, okay, I think there's one more push to the upside coming. If you want to get everybody bullish, take the S&P above 4,200. The August high was 43.25. I don't think that will get taken out. So for me, it's like, get this rally, sell into it, look for a place to go short. And I've been holding off on looking to go short because I just have this sense that that bullish narrative that Wall Street wants to embrace is going to help the S&P get above the 41.95.
So what does that do for the bond market, Jim? You got TLT, you still forecasting a higher move in bonds and
Yes.
rates to come down.
Yes. Yeah. I mean, basically what I'm looking at is from the low last October, that big rally from 91.85 to 109.88, wave A, you can see it there. Nice big capital. No, the one up above.
Oh, okay.
Yeah. Then we're in a corrective mode. A, B, C, we could maybe in some kind of a triangle here where the TLT has been chopping sideways. But I believe ultimately the TLT is going to break out above 110. And the length of wave A was about 17 points, call it 16 and change. I add that to the low at 98.88, and you get a move up towards 115 to 117. What's going to cause that? The economy's going to show more signs of materially slowing. I just think that's going to be pretty supportive. And we're going to continue to see inflation come down, especially in the next few months.
Okay. And so what does that mean for the dollar? I mean, the dollar's been holding up, and I was a little wary of the dollar this whole week, thinking that we might actually break down, but it looks like the jobs report saved us from breaking down yet, at least for now.
Yeah. I would say the response to me, for me at least, the response to the jobs number is a little disappointing, because I've been looking for the dollar to get above 102.23. It got there twice. Earlier this week, it got to 102.40, only to fade. So you need a close above 102.25. To me, that will really take a step forward to solidifying this pattern I have. Wave A, B pullback, based on, hey, the Fed's going to be cutting rates in the second half. I have felt that is the wrong perception. The Fed's not cutting rates, and that could provide a tailwind for the dollar to go back up in a wave C, back up to the 105.88. So, but its key is to hold and remain above 100.75. So,
well, Jim, I hear what you're saying. I don't know if I necessarily agree with you, but that's what makes a market. But you clearly defined an Elliott wave count in this pattern that maybe it will end up holding. Last but not least,
you have a great level to be able to define your risk.
Right, exactly. 100%.
1% from where we are, so that's okay.
Right. So gold, gold We almost made it to all-time highs. By
Yeah.
some accounts, I think it was. I think some trading systems actually had us going to all-time highs, but
No, I look at the cash
yeah,
because that's constant, and the high in August 2020 was 2007 D. I think it was March of 21, or was it March of last year? I can't remember now. 2067, and we got to 2000, I think 59.
got it.
So to me, that's a huge ceiling. I still look at it and say, okay, the key thing here is you got 1, 2, 3, 4, 5 to this most recent high. Whether we had a 4 and then this high yesterday was 5 is almost like doesn't matter. But the thing I will note is if you look at the bottom panel, that's the RSI, and you can see we've had 2 highs now where gold made a closing high higher than the prior, and the RSI is hitting lower highs. And when you do it a second time and the RSI is still below 70, that's usually a pretty good sign that you're running out of gas. And so again, 5 up to me implies the longer term trend now is up. We're going to new all-time highs, but I think you got a wave 2 correction coming over the next 1 to 3 months. And the 382 is just below 1900. Wave 4 of lesser degree is at the low we saw in February at around 1810 or so. So I just think the odds are wait for this thing to come in. And when things set up properly, you want to be aggressive because the next move up should be very dynamic. In other words, the rally from last September was wave 1 of the next big advancing wave. I'm looking for a wave 2 retracement, and then wave 3 will take us comfortably to new all-time highs. And that's my expectation. So now it's just a question of, all right, the enthusiasm level has gotten pretty somewhat excessive, and if I'm right about the dollar getting a bounce, the Fed not, really indicating, nope, we're going to keep the funds rate at 5. And I think that's going to be the messaging hard. They're going to try to get away from the idea of pause and emphasize the main thing is we're going to hold the funds rate at this level or slightly higher for a long time. And I just think almost every Fed member and governor is going to, those are the speeches we'll probably begin to hear next week.
All right. And speaking of next week, anything on your radar that we should be paying attention to that's really going to be a market mover next week?
I think the CPI comes out before the end of next week.
Yeah, it'll be Wednesday. Yep.
Yep. You got to look at the takeaway values from last year. And again, I'm not off the top of my head. It's a pretty big number. I know the next 3 months is 2.6%. So we're probably each month is like 70, 80 basis points. So the point being is if you're taking away 0.7 and you're only adding 0.2 or 0.3, guess what? The headline CPI is going to drop from 5% to 4.6, maybe 4 or 5. That's what's coming. The core is not going to come down as much for a number of different reasons. But again, the labor market is the key. And I still see on Wall Street, I'm not trying to pick on anybody, but Tom Lee keeps talking about, well, inflation's come down. Inflation's come. Yes, it is, Tom. But Powell has told us that the labor market is the key. And the unemployment rate's at a 50-year low. They're not cutting rates anytime soon. And everything that's happened over the last year with monetary policy, I think the full impact has been delayed because consumers had over $1 trillion worth of savings. The unemployment rate's at a 50-year low. Wage growth still really pretty healthy. So the economy, government spending, I just think we've delayed the onset of the pronounced slowing because of these other factors. But it's not going to change Fed policy because, they're happy about inflation coming down, but it's still double what it's supposed to be. So they're not going to say, oh, great, victory. We're at 4%, victory. No, that's not the way it's going to work.
That's like when you see the finish line and you're a sprinter, you're not going to, just because you see it, you're not going to slow down.
It's a great
Right.
analogy because you be a loser.
Yeah, right. So anyway, Jim, I got to say, it's always great meeting with you every week, and I'm sure everybody here that listens in appreciates it. So make sure everybody give Jim a big thumbs up and thank him for his time. Jim, how do we best follow your work?
Macrotides.com. Or as I said earlier, if you would like the May macro tides, send me an email, Jim Welsh Macro at Gmail. It's really a good letter this time.
All right.
Jim. I mean, they're always good, right,
yeah.
Blake?
But this one's really
some are
good.
better than others.
This one's gonna be a little juicy.
Yeah, no, it just sometimes everything kind of falls into place, and this was one of those months.
Well, take it for Jim's word. Take Jim for his word. Excuse me. Make sure you email him, jimwelshmacro at gmail.com. Jim, thank you again for spending your time with us. Have a great, wonderful weekend. We'll catch you next week.
You got it, buddy. Thanks, Blake.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.